Good morning, everyone. Today, what I wanted to talk about is going over tax planning. Specifically, tax planning as it focuses on wealth building strategies and then distribution strategies in retirement. I kind of want to start off and kind of really put an emphasis. This is not going to be a tax preparation topic. We're not going to be talking about how you need to file your taxes at the end of the year, what credits or deductions to take, whether you need to take standard deduction, anything like that. This is very much going to be on what type of accounts you need to use when building wealth, and then what are some strategies you can use while you're still working to kind of mitigate some tax related issues due to your investment earnings. And then what are some strategies when you do retire and you start taking income? What are some ways and what are some things you can do to lower your taxes or at least plan around when to take and pay those taxes based on what some of your goals are from that standpoint? But to start off, I really want to focus firstly on just what taxes are and how they're paid. So I want to kind of look at explaining tax brackets because I feel like there often is a common misconception when it comes to how your tax brackets work. And this is really going to be a foundational building block for what we talk about today as far as when to use certain accounts. So, in this example right here, I'm going to assume this person getting a raise is Jeff. So, Jeff, he has been working at this firm for a while. He just got a raise. So, let's say it's a $1 raise to make this simple. He's really excited, but that $1 puts him into the 24% tax bracket. So his excitement is great. He's like, yes, I got a $1 raise. This will be great. And then he's like, oh, wait, that's going to put me in the 24% tax bracket. And his immediate assumption is, well, now I'm going to be paying 24% on my income. So even though I got a raise, I'm going to bring home less. That is not how tax brackets work. So as soon as you cross over this threshold here into this 24% tax bracket, it does not mean that your entire income is taxed at 24%. Rather, that just that raise is taxed at 24%. You have to think of each one of those tax brackets as its own little pocket of taxation. So his first sleeve of income gets taxed at 10%. His next sleeve gets taxed at 12%. The next sleeve gets taxed at 22%. And then his raise and anything he makes prior to that, or more than that, I would say, is going to be taxed at 24%. So that's kind of the foundation. Just getting started. That's what I want to make sure we know is what you're looking at when we say marginal tax bracket, or you often just hear my tax bracket, is going to be the top tax bracket you're in, but that does not mean that is what you pay. What you pay is actually an effective rate. So with Jeff right here, his tax bracket or his marginal rate is going to be 24% because that's the tax bracket he's in, but his effective rate is going to be essentially the average of all of these. So it might actually be an effective rate of 15% or 16%, just give or take whatever this number in here actually is. So you have to take and say, all right, well, if this is always at 10, this section's always at 12, and this section's always at 22, well, this added 24 will raise your effective rate, but it's not going to be such a dramatic raise that everything will now be taxed at 24. It might take a effective rate that's 15% and make it like 15.1%. So even though he is getting a raise and it is increasing his taxes, it's not huge. And if we look at kind of history here, what we can kind of see is top marginal rate brackets change pretty frequently. So we have in the 70s, you had about 70% was the top marginal tax bracket. Then it dropped down to be like 50. You had it lower down, you had it raise up, you had it lower down, you had it raise up. But if you actually look at the average effective rate, it stayed fairly steady. It'll move up and down just slightly, but it's going to stay fairly steady even though those effective tax rates or those marginal tax rates do move up and down. So when we talk about retirement planning, we talk about tax planning around retirement planning, we need to make sure we're at least operating on the correct assumption of how taxation works. So moving on to different types of taxable accounts. I'm going to move my guy over here and then jump back over, is when we talk about investment accounts, there's really going to be two main categories that you can invest in when you're building your wealth. You can invest in retirement accounts or you can invest in taxable accounts. When we invest in retirement accounts, there's two main types of retirement accounts. There's pre-tax retirement accounts and there's post-tax or Roth retirement accounts. And then if you were to invest in a taxable account, there's really just going to be like they're taxable accounts. There's not going to be separate types because they're all treated one way from a tax standpoint. There are some intricacies in here, but we're mainly going to be focused just on your main kind of individual or joint brokerage account for today. Retirement accounts, the goal here is kind of exactly like it sounds. You're saving specifically for retirement. Taxable accounts, this can be used for retirement, but it can also be used for a goal that is not quite to retirement, like a 10-year goal or a 15-year goal, something you don't want to keep cash in hand for, but something you want to be investing for in the future that's not necessarily retirement at that point where you can invest it. Again, you're taking on risk. That's why it needs to be probably at least 3 to 5 years out, but it's something you might not be able to cash flow on a single year that you have to save over the course of many years for. But we're going to start with retirement accounts. And what we're going to look at is starting off with probably the most common account people use, which is going to be a pre-tax account. Now, a pre-tax account for most people is what they will use being their 401k. That is probably the most common pre-tax account. What a pre-tax account is you make contributions prior to paying taxes into the account. Those contributions grow tax deferred and they lower your tax burden this year. So it lowers your current year tax burden and it grows tax deferred. Types of accounts like 401ks, 403bs, 457 plans, simple IRAs, SEP IRAs, traditional IRAs, all of these are pre-tax accounts. So to kind of give you an example of a pre-tax account, where we can look and say, all right, well, if you were to make $100,000 of income and you were to put $5,000 into a traditional IRA, so a traditional IRA is an individual retirement account. It being traditional, it's pre-tax, so that $5,000 goes in pre-tax. Well, your taxable income for that year is only going to be $95,000. So what happens is you take that $5,000 out of your income, you put it into the pre-tax account, it lowers your taxable income, and then that $5,000 is able to be invested and grow for your retirement. So the kicker would be that 5,000, if it were to grow to say 50,000 by the time you retire, well, that full 50,000 when you take that money out will be taxed. So the $45,000 worth of growth is going to be taxed at some point. Therefore, it's tax deferred because you did not pay taxes on the initial $5,000. So the $5,000 helps lower your tax burden today, but you do have to pay taxes on the growth when you pull that money out in retirement. The idea behind when you want to use this really is going to be if you're in a higher tax bracket now than when you're in retirement and you're taking income out of that account. And we'll go over that a little bit more here in a few slides. The next kind of account type that's under that retirement account umbrella is going to be post-tax or Roth accounts. So when we talk about post-tax or Roth accounts, those are going to be contributions that are made after tax. So these are contributions you've already paid tax on those dollars. Then you make the contribution into that post-tax or Roth account and it grows tax-free for you in retirement. Now, there's a couple kind of other benefits. You have no required minimum distributions. And excuse me, I'm going to put on some chapstick here. Lips are cracking just a little bit. But so you're going to have no required minimum distributions. And what that is with no required minimum distributions is when you have a pre-tax or a traditional account that you're not paying taxes on, well, you're deferring those taxes. So just like in this example here, where this $5,000 grows to $40,000 or to $50,000 and take it out, well, the IRS eventually wants their money. So they want the money that you've deferred. So at a certain age, currently it's 75, but that changes from time to time, you will be required to take out a minimum amount from that account and pay taxes on it. With a post tax or Roth account, since you've already paid taxes, that is not going to be there. You also tend to be a little bit more beneficial for passing wealth. So if you were to pass a account to a child, it from a Roth standpoint, it's a little bit more beneficial than passing a pre-tax account to a child, just because of the tax rates that the child is going to have to pay and the way that the child will have to spend that account down. We're not going to get into specifics today on that, but just know it is more beneficial. And then from different account types, I always kind of make a joke. You'll notice how creative the IRS is here when you just have these same account types, but just add Roth in front of them. So Roth IRA, Roth 401k, Roth 457, Roth Solo 401k. But let's look at an example here. So we have the same example here. Someone making $100,000, they put $5,000 into a Roth account. So we're going to use a Roth IRA at this point. Well, their taxable income is still $100,000. So they're still paying taxes on that full $100,000, even though they put $5,000 into a Roth IRA, because that Roth IRA is a after tax or post tax account, which means if that Roth IRA in retirement grew to 50,000, very similar to the last example, so you had $45,000 worth of growth. Well, here's the real benefit to the Roth IRA is that $45,000 worth of growth on that account. So it gets to 50,000, you put in 5,000, so it's got $45,000 worth of growth. That $45,000 is never going to be taxable because you paid taxes on the $5,000 or contribution. The $45,000 worth of growth is not going to be taxable. So, whereas if you don't pay taxes when you make the contribution on a pre tax account, the account grows tax deferred, which means you have to pay taxes at some point. If you make that same contribution to an after tax account, the account grows tax free. And that is huge. So, that's where the real benefit of the Roth is. Now, the question is, when do I use them? So, this chart I really like to show because I think it does a very good job of going over when to use Roth IRAs and when to use traditional pre tax IRAs or Roth 401ks or pre tax 401ks. And it's usually two main rules you want to look at is how old are you? And then how much income do you make? So, what's your tax bracket essentially? So normally the younger you are, the more beneficial it is to add to a Roth IRA. So if you add that $5,000 at age 20 to a Roth IRA, well, you get decades and decades for it to grow tax free. So it can be really substantial. But if you're retiring at 65 and you add $5,000 at age 60, it's not going to grow that much in 5 years. So the benefit starts to look a little bit less at that point. Then, so you have your age, that's probably the first thing. Then you're looking at, all right, well, what is my income level? So as you get older and you start to get more income, you start to see going for Roth or post tax assets starts to look a little less favorable. And then you start to see, all right, there's going to be a period where you can do a little bit of both. And then you're getting those higher tax brackets. And that's where you really want to do pre tax and avoid paying taxes that year. So I always say, usually somewhere around your mid 40s. And as you get further into like the 24 or 25 or 30% tax brackets, depending on whatever the tax brackets are that year, because those will change too, that's when you want to start really moving into pre tax. Because what you have to look at is when you're in your highest earning years, your tax bracket is probably going to be pretty substantially higher than what your tax bracket will be in retirement. And you don't necessarily want to front load your taxes or back load your taxes. So you want to maybe try and avoid to pay some of these higher taxes here, knowing that when you do take that money out, so that pre-tax dollars that you'll have to pay tax on when you take the money out, you'll be taking it out at a lower tax bracket in retirement. So really two rules. Just remember, the younger you are, Roth makes more sense. The older you are and the higher your income is, pre-tax makes more sense. But those are going to be the two guiding factors in most cases that you're going to look at. Now, the other account category is going to be taxable accounts. So, taxable accounts are fun, but they are a little bit more complex when it comes to tax strategies because it's not a simple lowers your tax rate, increases your tax rate. It has to do with transactions inside the account. So, I'm going to jump into this. I'm going to take a little bit more time in this section to really walk through these examples because they get pretty in the weeds fairly quickly. And I want to make sure we take the time and have a good example. So if you were at either one of the presentations of this live, I did this a little bit slower. I'm probably going to go over or I did this a little bit quicker. I'm going to go over it a little bit slower today to make sure we have everything covered at that point. So first off, taxable accounts are made after tax contributions. They're not retirement accounts, so they don't have any tax benefit as far as putting money in or money growing tax free, but the money does go in after you've paid taxes on those dollars. So it would just be money you put aside after you've already gotten your net paycheck in. Now, there's not any limits on contributions or withdrawal time frames like retirement accounts. You have a specific time when you're allowed to withdraw without getting penalized. You have a cap at how much you can contribute on an annual basis. With a taxable account, there's none of those. Now, they do get capital gains treatment if you hold your assets in the account for longer than a year. We'll talk about that in a little bit. And then when we talk about taxable accounts, we're talking about brokerage accounts primarily today. You can have an individual brokerage account for one person, you can have a joint brokerage account for another person. There are other types of taxable accounts that do have slightly different taxation and are treated slightly different, like custodian accounts or trust accounts. I'm not going to get specifically into those because those are used very specifically in different types of planning. For the most part, if you're looking at just an individual or a couple trying to add a little bit more to retirement or saving for a rental property or a boat or something like that, you're going to be using more than likely just a regular brokerage account. So I want to focus on that being the topic today at this point. So typically, again, you would use a brokerage account if you have a goal that is not retirement specific that you want to be saving for, that's maybe 5, 10, 15 years away. Or you would use a brokerage account if you've already maxed out what you can contribute to retirement accounts. So you've already capped your annual limit of what you can add to Roth IRAs, traditional IRAs, 401ks, and you want to save more for retirement, brokerage accounts are a good option there as well. Now, when it comes to the taxation on brokerage accounts, and let me move myself over here. When we talk about taxation on brokerage accounts, it's not going to matter what money comes in or what money leaves like you would with a IRA or a Roth IRA. So what money comes in, what money comes out does not matter. So we can forget about that because again, there's no tax benefit to money coming in and money coming out. So the IRS doesn't really care. What the IRS cares about is what happens inside of that account. So let's look at a really simple example. You buy one share of Apple stock for $1. It's like 1985. Apple looks good. They just came out with the Macintosh. And you're like, this is the greatest company of all time. You buy them for $1. You hold them. Let's just assume you're holding them for a year, and then you sell it for $5 because you say to yourself, "Oh, Apple's going to be as big as it's ever going to be. I'm selling it for $5." So you have a gain of $4. Well, the year that you sell that Apple stock, you have to pay taxes on that $4 worth of gain. And I'll get here in a second on what those taxes look like. But if you hold it for at least a year, a little bit longer than a year, you're going to be paying long term capital gains rates, which are more favorable than short term capital gains rates. So when we talk about capital gains, you have to look at if you hold something for short term, you pay ordinary income tax rates. So if we go think all the way back to Jeff, if Jeff had a brokerage account, the very first kind of scenario we looked at with those tax brackets, he's in the 24% tax bracket. So if he held this share of Apple and he sold it and he only held Apple for like a month before he sold it, well, he's paying 24% on that $4. But If he were to hold it for a year, he gets treated for long term capital gains rates. Long term capital gains rates are going to be much more favorable at either 0, 15, or 20%. So he would fall in this between $44,000 and $500,000 range. So he would be paying 15% capital gains rates as opposed to 24. So when we talk about capital gains, long term is good, short term is bad. So think short term bad, long term good. So you want to realize or sell things when you have long term gains, but you have to hold it for at least a year. So you look at this example, he has that $4 gain. That's a pretty big difference between 15 and 24%. So now what happens if you have a loss? So if we have a loss, so say he buys Apple for $5 because he's heard it's great, but he sells it, it loses value, sells it for $1. Well, now you have a loss, a $4 loss. So you do lose money. You don't have to pay taxes on that loss because it's a loss. So you have no gain out of it. So there's no taxable gain you need to pay. But what you can do is you can use that loss to offset other gains. So we'll talk about that in a second. So even though you have a loss, it's not a complete waste because you would be able to use that loss if you do it in the same year or a future year to offset a gain at that point in time. So we talked about tax brackets here. So long-term capital gains tax brackets. There are some strategies in your working life that you could try and realize some 0% capital gains if your income's below this threshold. And there are some times where you want to realize it at 15 if you think your income's going to get really, really significant. I will say the example we'll be using here in a second is from a prior year. So the dollar values here are slightly different, but the capital gains brackets are still the same. But let's look at an example of what you might do if you were tax loss harvesting. So, when I say tax loss harvesting, what I mean is you were trying to net out a gain and use some losses in your account to try and avoid paying taxes. So, this example, and we'll go Gary here. So, Gary buys, let's say he buys Microsoft stock. He thinks Microsoft really well. So he says, all right, I'm going to buy Microsoft. And he's doing it to eventually buy a new car. And that car is going to be 10 years away. So he buys Microsoft and it grows, or sorry, that car is going to be 9 months away, for example, here. And it grows. He has a $20,000 gain on it and he sells it. Well, he has a short term gain of $20,000. So, short term gain, or short term bad, he's going to pay it at his ordinary income rate. So, his ordinary income rate is 32%. So, he's looking at essentially $6,400 of taxation on this $20,000 gain. But he also has stocks that are at a loss. So he bought Peloton. It was the height of the pandemic. He thought everyone was going to work out from home. And he was like, Peloton, that bike is phenomenal. It's got a little screen on it. It's never going to get out of style. And now it's just essentially a coat hanger for probably most people. So he took a massive loss on that. So he doesn't think Peloton's going to do better at any point in time. So what he wants to do is he knows he's selling Microsoft. He wants to go ahead and realize some losses. So sell off some of that Peloton stock and offset some of the gain from Microsoft. So he sells off $25,000 worth of losses from Peloton stock. So what he can do is he can take 20,000 of those losses and he can offset the $20,000 of gain he had from that Microsoft stock at that point. But then he has $5,000 left. Well, he can do another thing. So he can take 3,000 of that loss and he can count it towards his ordinary income. So that 3,000 is able to count towards his ordinary income. So if we look down here, that $3,000 at 32% would be $960. So by selling off his Peloton stock at the same year that he's selling off that Microsoft stock, he can save himself about $7,360 of taxes on these gains by kind of utilizing something that had had a loss in his portfolio. And then you might be asking yourself, well, there's still $2,000 left. That can actually be carried over to next year. So if he has a gain on something else, he can use that $2,000 against it. So to give you kind of an example, like a real life example. So there was a few years ago, ProPublica published an article essentially about billionaires and their tax returns. And it kind of drummed up a bunch of hubbub because you saw like years where like Elon Musk and Jeff Bezos did not pay any taxes, even though they're billionaires. Well, what happened was essentially this on a very, very large scale. So, if we look at Jeff Bezos specifically, there were years where he was investing in Blue Origin, his little space adventure program, and it just burned cash. So, he lost hundreds and hundreds and hundreds and hundreds of millions of dollars doing that. Well, he was able to take those losses and carry them over to a future year, a year where he sold Amazon stock for a gain and net those out. So, yes, he did not pay taxes, but he didn't pay taxes because he had massive losses in one investment that he was able to realize and then carry forward and net those against his investments that had a gain, which would be Amazon stock. And he did that very similar to what Gary's doing right here with 20,000, but on a huge, huge scale at that point in time. Now, if we look at an example like this, so this is kind of a smaller example or an example of how to try and take advantage of those tax bracket windows within those capital gains brackets. And this is where I say this is a slightly older example. So you have slightly different bracket numbers, but the idea works regardless. And you could do this while you're working, or you could do this in retirement. I have another example specifically looking at retirement, but this is going to be something you could use if you have a spouse that is commission based and they have a lower amount of income one year. You could look at doing something like this. If you have a spouse that takes maternity leave, if you have a job change, so you have a year where there's a few months you don't have regular income coming in and it lowers your overall salary, these are perfect years to try and harvest some gains or pull from a brokerage account and try and really utilize this 0% tax bracket if you have it available to you. So in this example, you have someone making ordinary income of $50,000. Then they're taking standard deduction, personal exemptions on their tax return, and they realize long-term capital gains. So again, we're talking long-term capital gains, not short-term capital gains where we're doing ordinary income, but long-term capital gains where we're getting those favorable 15% brackets at that, or 15% tax rates. So what you're looking at is between the $100,000 of income, so the ordinary income, and the $50,000 income, you back out standard deduction and personal exemptions, you've got just under $80,000 of actual income. Now, what happens is you're going to have a portion of that ordinary income at a 10% tax bracket. You're going to have a portion of that ordinary income at a 15% tax bracket, but you are going to have a significant amount of that capital gains be at the 0% tax bracket. So if you are looking married filing joint and you're like, oh man, I we only have $50,000 coming in between the two of us, that 0% capital gains bracket goes all the way up to about the high of just below 80, which again, it's a few years ago. Now it's just below 90. I can realize a lot of gain in my account and not pay a huge tax because that'll be the 0% tax bracket. Now, that gain is going to increase your income though. So the last little bit of that gain, that 50,000, will be taxed at that 15%. But what you're looking at, since all of this is in that 0% capital gains bracket, you're only having a tax liability of about $4,400 for $100,000 worth of income, because you're getting the standard deduction and personal exemptions on your tax return. So that's lowering your income. But then you're only looking at these 10% here, the 15% here, then the $885 of the 15% here. So a huge bulk of this is going to be that 0% capital gains. So you would be essentially during working years where you have lower income. Again, it's not going to be applicable to everyone, and you're not going to see this happen every single year. But if you have a year where you have marginally lower income or like a very dramatic income drop, a period like this, and you have a brokerage account, you can realize gains, and you can do that to pay 0% taxes on it. Now, this does not mean you are taking money out. So it's not necessarily meaning this $50,000 is going to be removed. So it's not going to mean you're going to sell Microsoft stock and take it as cash. No, that's not the case. You can just sell Microsoft stock and then repurchase something else to still keep the money invested. And if it's a gain, you can actually repurchase Microsoft stock. So what you would be doing is you would just be resetting your cost basis at a 0% tax rate. So say you had Microsoft stock and you bought it for $1 and it accrued a ton. So it was like that stock was now worth $8,000. Well, if you sell it, you're going to owe $7,999 worth of gain. So worth of gain on that. So you're going to have to pay taxes on that, essentially $8,000 of gain. Well, if you are in this 0% tax bracket, the 0% capital gains tax bracket, in a year like this, you could sell Microsoft off, realize that $7,999 of gain, pay 0% taxes on it, then just immediately repurchase Microsoft with that same dollar amount. Well, now your cost basis, so the purchase price of that, rather than being $1, is $8,000. So if you were to sell it off and have to pay taxes on it later, you're paying taxes on a gain larger than 8,000. So you can do this to try and make sure not only you lower taxes while you're actually needing to pull that money out, but to make sure you're setting yourself up in a year where you have that flexibility. So a future year where you actually do need that money, you're not looking at a huge tax burden at that point in time. So again, that is a pretty complex process, but it is something I think is extremely useful and extremely good to know about. So if you do have a brokerage account and that is somewhere where you are saving and you are putting money into, I'd say probably the number one thing to do with a strategy like this is just know when the opportunity is there. So the reason I go over this isn't necessarily so you can go and do it immediately, because it's not always going to be applicable. But you do need to at least know that this opportunity exists. So when you go through a year like this, there is a little flag that pops up in the back of your mind that says, hey, I can use this year that's usually pretty rough because your income's much lower, to at least put myself in a better position to where I can pay lower tax in future years by using a strategy like this. So it really is a great, great opportunity to kind of take effect. Now, looking at distribution strategies, so moving away from building wealth and moving into taking income from that wealth. So, we're going to start off with just some baseline distribution strategies. And really, there's going to be two main distribution strategies that most people are going to use. And it's going to be dependent upon what kind of assets you have. So, if you have taxable, pre tax, Roth assets, how to use them. So, traditionally, the traditional avenue is going to be pulling from your taxable accounts first, which is in red, then your pre tax accounts, which is in green, and then your Roth accounts, which is in purple. What this does is if you have a lot of gain in those accounts, you want to pull from the taxable accounts first, because that's going to be your main income, and really utilize that 0% capital gains bracket. So that's going to be where you want to hit. And that's why you want to really avoid pulling from the pre-tax. It's going to count as ordinary income for you, and use those in those early years of retirement where maybe you're not taking Social Security yet, or maybe Social Security isn't or only one spouse is taking Social Security, or Social Security just started, so you're not getting a full year yet, and you want to try and avoid paying capital gains rates. Then you're going to start pulling from your pre-tax accounts, and you want to save Roth accounts for when typically your healthcare expenses are going to be higher. But what that mainly does is it limits your taxable income really to that middle years of retirement. Now, the other strategy that you often see used is kind of a more proportional, where you pull a little bit from taxable assets, a little bit from traditional assets, and a little bit from Roth assets every single year to kind of balance it out. So you see a more even tax burden throughout retirement. Now, if you just have 401k assets, you don't have to worry about this because it's all going to be treated the same anyways. Or if you just have 401k and Roth assets, you don't have to worry about this as much. And then, like, if you just have 401k, you just have Roth assets, and you're not looking at like a large taxable asset base, then really what a lot of times we recommend would be using the IRA as your regular income. And then on years where you have a big extreme expense, like you're buying a car, you're fixing a roof, you're buying a hot water heater, a AC unit, you would use the Roth IRA assets to cover that so it doesn't push you into a higher income bracket at that point in time, or it doesn't push your Social Security taxation up from that standpoint. So, but that's going to be kind of your baseline distribution strategies, just depending on where your assets are located going into retirement, is really going to be a big factor on how you could probably pull from your accounts to maximize your tax liability. Now, the next is going to be harvesting capital gains. So, this is very similar to what we had just talked about with the tax loss harvesting and harvesting gains examples just a few slides ago. This is where you're still in that 0% capital gains bracket. So right here below this income rate is that 0% capital gains bracket. You're bringing in $30,000 from your traditional IRA. You're getting your standard deduction. So that's looking at about $19,000 of taxable income. Well, then you realize $8,000 of a brokerage account, and then that's at the 0% tax bracket. So you're doing that every single year, and that's what you'd be doing kind of this proportional. You'd pull a little bit out of the IRA, you'd pull a little bit out of the essentially taxable account. That's going to get you a 0% capital gains rate here with the tax bracket here, or the tax rate here. And then if you need anything else, pull out of the Roth. But you do that on an annual basis, even if you don't need this, to either reset your basis, which is kind of what we talked about with selling that Microsoft stock to take that $1 worth of purchase price and move it to $8,000 worth of purchase price without having to pay taxes on it at that point. So you're either doing it that way, or you're doing it to continue to bring in some income for you, but do it the lowest tax rate possible. So harvesting gains in every single year, even for a little bit, can be very, very helpful. Now, the next kind of task or strategy you can look at is a Roth conversion. So, a Roth conversion is primarily used right after you retire, typically either before you start taking required minimum distributions at like 75, or before you start taking Social Security. And this is going to be where it's really used the most, because you're going to have this window where you see no earned income anymore. So your tax bracket's going to drop down tremendously, and you're not going to have Social Security coming in. So really the only income you have coming in is coming out of your IRA account. So if one of your goals, and this can be for two goals, if one of your goals is to pass assets to your children, well, one of the things we talked about was Roth assets being more beneficial to kids from an inheritance standpoint. And if you want to lower your tax bracket in the later years of retirement, Roth conversions can be really, really useful. Now, a Roth conversion is where you take a little bit out of your IRA or your 401k and you convert it to Roth. So you're taking from the IRA and you are converting to the Roth IRA in a year. So you might say, all right, well, let's say you have $500,000 in a 401k, and you want to take 10,000 of that, and you want to take 10,000 of that and take it from the 401k or your IRA, and you want to convert it to a Roth IRA. Well, you take 10,000 of that, you're paying taxes on that 10,000 that year, but that 10,000 then goes into a Roth IRA and grows tax-free for the remainder. So what can happen in this scenario is we might be converting enough to fill up this 12% tax bracket right here, from 60 to about 65, and a little bit up right here. But what that does is we do that conversion in this window right here. So that might be $20,000 a year. And you'll notice if we track this blue line up here, it lowers the amount of taxation you're paying later on, because that required minimum distribution gets lower. Your healthcare costs aren't going to push you as high because you're going to have tax-free assets to pull from. So it actually lowers your overall tax burden throughout retirement by paying cheaper brackets here to keep you out of these higher brackets up here. So I mean, this high bracket up here is now going to be lowered right to about that 24% bracket at that point. So you can use these to essentially lock in lower rates earlier in retirement to hedge higher rates later in retirement, from that standpoint. Also, what it can do is it can give you a higher tax-free asset base to pass to your children. So when you pass accounts to your children, you pass a like an IRA or a pre-tax account. Well, that child typically is going to inherit assets from a parent, usually in their 50s or 60s. That's when most people start to inherit, or their parents pass away and they start to inherit those assets. Well, if they're inheriting that in their 50s and 60s, they're probably sitting pretty close to their highest earning years, which means they're going to be in their highest tax bracket. So if they're inheriting a IRA, well, they're going to be required to start taking income from that, and be able to, and have to draw that account down. And as it sits right now, about 10 years. So they're going to have to pay a decent amount of tax on that, probably a pretty significant amount of tax on those assets. So when you pass money in a tax deferred account to a child, you're passing a decent amount to Uncle Sam. Now, if you have a tax free account, you're paying the taxes, but you're paying the taxes here and you're paying the taxes at maybe 12, 15%. So your kid who's probably in this tax bracket up here, which might be the 22 or 24 or 25%, is now getting tax free assets. So you are paying 12 to 15% rates earlier in your retirement so that your kids can get most of that money, because it'll come to them and they can take it out tax free, and you're passing more to your children and less to the IRS at that point in time. Now, it works very different with brokerage accounts. I'm not going to get into that right now. Now, as far as Social Security taxation and Medicare taxation, so what I want to talk about first is Social Security taxation. So, how your Social Security is taxed. So, your Social Security is taxed on your ordinary income tax rate, but the amount that is taxable is what matters. So, this is a very fun, not plain at all chart about Social Security taxation. So I want to look at married filing jointly. So if you make below 32,000 in retirement, your Social Security is tax free. If you make between 32,000 and 44,000, up to 50% of your Social Security may be taxable. And if you make more than $40,000, $44,000, up to 85% of your Social Security income may be taxable. Now, right off the bat, that does not mean you are paying a 50% tax rate or an 85% tax rate. That means you are paying whatever your ordinary tax rate is, up to either 50 or 85% of your actual Social Security benefit. Now, let's look at an example here. So, first off, you have to figure out what is your actual income. So you have to look at, all right, well, my IRA distributions are going to count. So that's 32,000. I might have rental property. I might be pulling from a brokerage account. That's another 12,000. And then you need to count 50% of your Social Security payout. So like 50% is going to be 18,000 for this person. So his provisional income or combined income, you'll hear him referred to either way, is going to be 62,000. So if we come back over here, 62,000 is more than 44,000. So up to 85% of his Social Security may be taxable. Now, let's see what that actually means. It means that from 0 to 32,000, out of that 62,000, that's 32,000 of it, none of that will be taxable. So none of that will be taxed, of that Social Security payout will be taxable. The next $12,000, so from $32,000 to $44,000, 50% of that benefit will be taxable. So out of that taxable Social Security, 50% of that will be taxable, so $6,000. And then anything above $44,000 from that income standpoint, so out of that $62,000, that's $18,000, which means 85% of that will be taxable. So that puts your taxable Social Security at $21,300. Now, if we look at that, his total Social Security payout altogether is going to be $36,000. So this is where we say up to 85% and not 85% directly. So it tiers up. If he was over 44,000 and it was just automatically 85% of your Social Security would be taxed, that means $30,600 of his Social Security would be taxable. But it tiers up, so it's stair steps. It's not a cliff. It doesn't get to 44,000 and just cliff over to 85%. It stair steps up, so it's only 21,300. So you have to think of that as it's not a cliff. That's why this says up to and up to right here. So up to 50 and up to 85 is because it's not a cliff. So it's a little complex. You can look at it on your tax return and kind of there's a formula for it. But what you really need to look at is the further you get above 44,000, it's going to get closer to that 85%. But if you're just over that 44,000 threshold, you're not going to see a full 85% be taxed. You're just going to see probably a rough somewhere between 50 and 85% be taxed. Now, when it comes to Medicare, Medicare operates on a slightly different spectrum because you're technically paying Medicare premiums. And you're paying Medicare premiums specifically for Part B and Part D. And when we talk about Medicare as it relates to retirement income and how that income affects it, you're talking about your IRMAA or your income related monthly adjusted amount. So, what this means is the amount you bring in not only affects how much of your Social Security is taxable, but it is going to affect how much your Medicare premiums are. Now, the bright note is these premiums adjust at a really high level of income. So for most people, you never have to worry about this adjustment. Probably the biggest question mark is going to be if you were to do a Roth conversion 1 year and it bumps you over the threshold for that point. But what this income related monthly adjusted amount is it has a 2-year delay, but it affects the premiums you pay for Medicare Part B and Medicare Part D. But that 2-year delay means that if we're sitting in 2023 right now, your Medicare Part D and Part B premiums that you are paying are going to be based on your income in 2021. So if you had a high income in 2021, that could raise your premiums in 2023, but just for 2023. They would drop back down in 2024 if your income was less in 2022. And when we look at that bracket amount, this is what we're looking at. And this is why I say it's fairly high. So if you're married filing joint and you make under 194,000, well, you're paying the regular premium. So 164 for Part B and Part D is free at that point in time. But if you do something and you push your income to be above 194,000, well, you are getting an additional $65 charge, onto that Medicare premium, or an additional $12 charge onto that Part D premium. So you'd be paying $230 plus $12 at that point. And if your income gets higher and higher and higher, that added expense gets more and more and more at that point in time. Now, in reality, what this technically means is if you are in this top line, so you're less than 194, well, you're paying 25% because that payment is actually showing what Medicare is covering and what part of the cost you are covering. So for Medicare, your standard is that you cover 25% of the cost. If you start to make more, what happens is that extra surcharge is just increasing the percentage that you were actually paying. So at most you pay 85%. So if you're over 750,000 as married filing joint, well, you are paying 85% of those Medicare costs, and Medicare is only covering 15% of that. So when we look at those, you do have to hit fairly high income thresholds, but Very rarely does it happen, and it has a 2-year delay. But I say all this because with Social Security, with Medicare, none of this happens in a vacuum. So if you take Roth conversions, if you realize capital gains, depending on when you take Social Security, all of these things affect your Social Security taxation, what your Medicare premiums are going to be, whether or not you can pull from a brokerage account and keep it at the 0% tax bracket, what your tax rate is going to be in retirement. And all of this, too, is really built on how did you save? Did you save everything into a 401k? So, really, not a lot of this applies to you because you're really locked in. Did you blend it between a Roth IRA and a 401k, or Roth IRA, a brokerage account, and a 401k? I mean, what did you do at that point from a savings standpoint? But just know all of these works together. So you can't just say, I'm going to do this one thing and it'll work out fine. You really need to make sure you're starting to plan ahead and plan for, how do I want to take money out in retirement? How do I want to kind of plan for this? What lowers my tax burden this year, but also gives me flexibility in retirement at that point in time? And it's just a lot to think about. So if you want to sit down and meet with one of the planners, reach out to us with My Retirement Plan at investplanadvice.com, or give me a call at this phone number here. You can always reach out to the benefits department for Forsyth County employees as well. Again, this has been a coverage of the tax planning presentation we did for eligible Forsyth County employees over this last month. I did a little bit more detail today. Hope you enjoyed it. We'll be putting more of these out there and doing more presentations, and have a great day.